Okay, this next section is a section that I often get comments from people that send in and say, this was the least important thing to me. And what they're telling me is this, that they're not really buying a lot of stuff to operate their business. Because this is very important if you're going to buy equipment or things like that. And I've been giving the tax preparers kind of a rough time all day. However, I will tell you they are really good at this. When you go to your tax preparer, they understand Section 179 deduction and depreciation. And this is very important to you if you're thinking about building a building, buying equipment, whatever, to run your forestry operations. All right. This is covered in Ag Handbook 718 on pages 29 through 38, but I will tell you that the Ag Handbook 718 is not the source to go to learn what you need to know about depreciation. Ag Handbook 718 is designed to cover the forestry aspects of depreciation. There are a number of IRS publications that cover this subject. The best one is publication 946, How to Depreciate Property. Again, all these publications are available on the internet, and you can get them from the IRS also in hard copy format free of charge. So what are we talking about when we're talking about depreciation? Depreciation is the annual deduction allowed to recover the cost or other basis of business or other income-producing property with a determinable useful life of more than 1 year. If it has a determinable useful life of less than 1 year, we know we can expense that. Property is depreciable if it meets the following requirements. It has a determinable useful life. It wears out, decays, gets used up, becomes obsolete, or loses value from natural causes. And it is either used in a business or held for the production of income. Here's some examples of depreciable forestry assets. Bridges and culverts, fencing, temporary roads, trucks, power saws. So as a forest owner, you may depreciate most property used on your land if you hold your woodland as either a business or as an investment. Land is never depreciable. And why is land never depreciable? Never wears out, decays, gets used up, etc. Okay. But certain land improvements are depreciable, such as fences, temporary roads, surfaces of permanent roads, bridges, and buildings. So to claim depreciation, you use this awful-sounding thing called the Modified Accelerated Cost Recovery System, which we call MACRS, established by the 1986 Tax Reform Act for most tangible property placed in service after 1986. Remember 1986, they were going to simplify the tax code, and we had a thing then called the Accelerated Cost Recovery System. Well, they changed it slightly, and then it became the Modified Accelerated Cost Recovery System. And this is just an aside here. Some types of property must be depreciated using the MACRS Alternative Depreciation System, which generally provides for longer recovery periods and lower depreciation deductions. ADS is beyond the scope of this seminar and will not be covered, and you probably will not run into ADS in your forestry operations. Okay, to figure your MACRS deduction, you must first determine the following information about the property you intend to depreciate. First of all, you need to know the basis, and by now we all probably ought to have a pretty good idea what basis is, the placed in service date, the property class and the recovery period, the appropriate convention to use, and the appropriate depreciation method to use. Now, this is starting to sound a little bit complicated. Don't worry, it'll all start coming together here when we get into a couple of examples here. All right, basis is the measure of your investment in the property for tax purposes, and for property you buy, your original basis is usually its cost to you. The placed in service date. Depreciation begins when your property becomes ready and available for a particular use, regardless of whether the property is actually put into use at that time, and regardless of whether the use is associated with a trade or business, production of income, or a personal activity. Okay, now we shift and find out this other thing, the property class and recovery period. Each item of property is assigned to a property class. The property class establishes the number of years over which the basis is recovered. This period of time is called the recovery period. And here is the chart right out of Ag Handbook 718 that shows the recovery periods by property class. And so now I'm going to give you a little bit of a quiz here. What is the recovery period for a pickup truck? 5 years. What you do is you look through all of this for a pickup truck, and there it is right there. And the recovery period is 5 years. Now you have this thing called conventions, and we've already talked about one convention this morning. We talked about the half-year convention, where we're talking about the tax credit and amortization, or the amortization now. What do we mean when we're talking about the half-year convention? This is an accounting assumption that treats all property placed in service or disposed of at the midpoint of that tax year. So with the amortization, it doesn't matter when you planted those trees. The assumption is made that you did it on July 1, which most people don't plant trees on July 1, but it's at the midpoint of the year. Mid-quarter convention. This accounting assumption treats all property placed in service or disposed of at the midpoint of the quarter. And then, of course, you can probably guess what the mid-month convention is. This accounting method assumes that all property placed in service or disposed of is done at the midpoint of the month. So which one of these three conventions do you use? Well, as a general rule, you're going to use the half-year convention to figure the deduction for property other than residential rental and non-residential real property. So most of the time, you're going to use the half-year convention. But if during any tax year the total depreciable bases of all makers' property placed in service during the last 3 months of the tax year exceeds 40% of the total depreciable bases of all makers' property placed in service during the tax year, then you're going to have to use the mid-quarter convention instead of the half-year convention. And, of course, this is set up to keep taxpayers from buying all their equipment at the end of the year and getting a half a year's credit for it rather than the last month or so. The mid-quarter convention must be used, and I just said that. So the mid-month convention is used for residential rental property and non-residential real property. So we're going to always use the mid-month convention when we're talking about real property. We have a number of depreciation methods. First of all, we have the 200% declining balance method. You use this method for non-farm property in the 3, 5, 7, or 10-year class, and you apply either the half-year or the mid-quarter convention. We have the 150% declining balance method. You use this method for all farm business property except real property, and for all other property in the 15 and 20-year property classes, and you apply either the half-year or the mid-quarter convention. You can use the straight line method. Well, this one, you always use this method for residential, rental, and non-residential real property. And here you apply the mid-month convention. So real property, mid-month convention. Straight line method. You can also elect to take the straight line method on a piece of equipment instead of using either one of the other two declining balance methods. I don't know why you'd want to do this, but somebody probably would have a reason. And you have to make an election by entering SL in column F of Part 2 of Form 4562. And once you make the election, you're stuck with it over the entire recovery period. So you can't start out straight line and go, oh, gee, I wish I'd taken that double declining balance method, and it's too late. Once you take it, you're committed to it. Here's another method of depreciation that is available to forest landowners that can come in quite handy. You can elect to exclude certain timber-related property, for example, temporary logging roads, from makers and depreciate under the unit of production method. The property is depreciated based on the number of units of timber harvested in a tax year compared to the total number of units harvested over the life of the property. And here's a good example. Cost for temporary logging roads, bridges, and culverts constructed solely for use in harvesting a specified timber tract in which on completion of harvesting will no longer be useful to the timber owner. So let's look at an example here using the units of production method. Let's assume you spent $10,000 to build a temporary road solely to harvest 400,000 board feet of timber. The logger is going to harvest 300,000 board feet this year, and then he's going to harvest the remaining 180,000 board feet the next year. So what are your depreciation deductions? Well, under the unit of production method, you can depreciate the cost of the road over 2 years. And it's just like John was working out here, you proportionally allocate by the volume. So you're doing a percentage here, 300,000 out of 480,000 times the basis of $10,000 equals $6,250 the first year, and then you get the remainder the second year. Now what's so good about this is that normally to depreciate this road, it would take you 7 years using the other methods. Here, we're using this method, you can do it in 2 years. All right, you can determine your maker's deduction in one of two ways. You can actually compute the deduction using the applicable depreciation method and convention over the recovery period, and they show you how to do this in in IRS Publication 946. Or you can use the IRS percentage tables that are in the book there. The table to use is based on the depreciation method, recovery period, and convention. And then the percentages in the table are applied to the unadjusted basis of the property each year of the recovery period. And we're going to have an example here in a minute. But somebody told me once, it was in one of these classes, it said there's only 2 types of people that actually compute their amortization deduction: accounting professors and fools. So he recommended that everybody use the tables. Of course, you go to your tax preparer now, it's already in their computer system. It's a software system that just crank it out automatically. But for any of us that took accounting, I don't know how many of you took accounting, but you'll remember having to grind out all of these calculations to get your depreciation deductions, and it can be quite lengthy, and of course there is a great opportunity to make errors. Here's an example of a maker's 200% table using the half-year convention. I cut this right out of Publication 946. And of course you can't see that very well, so what I've done is condensed it down a little bit for the first 3 columns there of the 3, 5, and 7-year part of the table. Let's talk about 5-year property. Then what you do is you multiply the basis here of 20% times the basis in year 1. Then you multiply 32% in year 2, and then it goes down like this. Got a question for you. Why is there such a jump here between year 1 and year 2? Why would you get 20% the first year and 32% the next year? Remember the half-year convention? You're only able to claim 6 months this first year. That's why you end up with a 5-year recovery period that lasts 6 years. Okay, let's look at an example here. Let's assume you buy a pickup truck for $12,500 that you will use entirely for your forestry operation. So let's calculate our depreciation using the maker's tables. First, we need to determine the recovery period by property type, and I have already gotten you to do that. We know that this pickup truck has a 5-year recovery period. Next, you need to determine the correct maker's depreciation table by the appropriate convention. So since this is 5-year non-farm property, we're going to use the 200% table, and we're going to assume that you bought it sometime in the middle of the year. So then you're going to use the half-year convention. So here's how you calculate your depreciation. You multiply the basis, $12,500 times 20%, and there you deduct $2,500 the first year. The second year it jumps up to 32%. And you deduct $4,000. So in the first 2 years, you're going to depreciate $6,500 of that pickup truck. And then, of course, it's going to take you another 4 years to depreciate the rest of it. You'll notice these figures change. So anyway, that's how you do that. Also, if you use the truck only 70% of the time for business purposes, then you can only claim 70% of those above amounts. All right, here's this other thing. This is a thing that's called the Section 179 deduction. What this is a special form of accelerated depreciation. Okay, you're eligible to deduct immediately up to $102,000 for the 2004 tax year of the cost of qualified depreciable personal property, single-purpose agricultural and horticultural structures, and certain other types of tangible property used in your timber operations if it qualifies as an active trade or business. So this is an important distinction here. because you don't want to be an investor. If you're an investor, you can't take the Section 179 deduction. And we talked about depreciating that pickup truck over 6 years. If you're in the trade or business, you can actually deduct that pickup truck in 1 year using the Section 179 deduction if you're in the trade or business of growing timber. You cannot claim the Section 179 deduction on property you hold only for the production of income such as an investment. Also, an estate or trust cannot make this election, and you must elect to take the deduction for the tax year in which the property is placed in service. You can take the deduction on an amended return only within the time prescribed by law for filing an original return for that year, including extensions, and report the Section 179 deduction on Form 4562, which is the same form that you take your depreciation on. Also, you've got to remember that this deduction is limited to aggregate taxable income attributed to your active trades or businesses, including income earned as an employee and certain timber sale income. So if you're going to take the Section 179 deduction, you do have to have income that matches that. But that income is not just income from your trade or business and timber. It can include all your income from all these other sources, such as income that you earn as an employee. The amount of eligible cost that is not deductible in 1 year due to the above limits can be carried forward indefinitely to later years until it can be deducted. And the deduction is reduced $1 for each dollar of investment over $410,000 during, this is really for the 2004 tax year. Thus, if you place $418,000 of qualified property in service in the 2004 tax year, only $94,000 qualifies for the deduction. So clearly we can see that here this is a tax break for small businesses. You get a business like Plum Creek and they're buying all sorts of equipment. They're not even going to be able to take the Section 179 deduction. And here is the curious thing that's happened with the Section 179 deduction. Before 1997, it was $17,500. Then it went up to $18,500, $19,000. Then it went to $20,000, $24,000, oops, $24,000. George Bush right there. There's George Bush influence charging the Congress. Also, 9/11 had something to do with that too, I think. But anyway, it went from there to there. And now, of course, it's $102,000. So let's look at a Section 179 deduction example. Let's assume you invest $7,000 in a used truck and $20,000 in a used tractor, both for your timber businesses in 1999. So that means we're going to go back to 1999. And what was the 170? So it was $19,000 then. All right. You have $9,000 of aggregate taxable business income for the tax year in question. So you can elect on Form 4562 to expense under Section 179 the $7,000 cost of the truck and $12,000 of the cost of the tractor for a total of $19,000, which was the maximum Section 179 deduction in 1999. Or you could elect to take all $19,000 on the tractor. However, your deduction for the year is limited to $9,000 of aggregate active trade or business income. So the $10,000 difference can be carried forward to future years until it gets used up. Also, here's something you really don't want to get involved in if you can help it, are these recapture provisions. The net benefit from the Section 179 deduction must be recaptured if the property is not used in an active trade or business more than 50% of the time in any tax year before the property's recovery period expires. So if you take 179, you've got to use that piece of equipment at least 50% of the time in your trade or business over the recovery period. If not, you're going to be stuck with trying to recapture this on Form 4797. And that's not fun, I can tell you. I've tried doing it, and I had to work with that on the taxes when I was when I was a tax preparer. So let's look at a multiple depreciation example here. Oh, I want to say one thing. If you're going to take the 179 deduction, ask yourself, are you going to be able to use this thing 50% of the time in the trade or business over the recovery period? Because if you're not, you probably don't want to do it. All right, now we're ready for the multiple depreciation example. Forrest Stump, a calendar year taxpayer, spent $20,000 for a multi-purpose machine shed, which he placed in service in July of 2000. He additionally purchased and placed in service in his business and used a used $30,000 skidder in September and a $60,000 used over-the-road tractor in October. No other depreciable property was placed in service by him in 2000. Forrest's net taxable income from all his trade and businesses for 2000 is assumed to exceed $20,000, which was the limit of the Section 179 deduction in 2000. So what are his total depreciation deductions for 2000? All right, the machine shed does not qualify for Section 179 because it's not personal property, nor is it a single-purpose agricultural or horticultural structure. It's real property, doesn't qualify for the Section 179 deduction. Since he fooled around and put more than 40% of the bases in the depreciable property during the last quarter of the tax year, the mid-quarter convention is going to have to be used. And so this is what his depreciation and Section 179 deductions are going to look like for year one. So the Section 179 deduction, which on the skidder, he took the entire $20,000 right there on the skidder for the Section 179 deduction. Then he has he's taken his maker's deduction on the skidder. Wait a minute, he's taken $20,000, the entire $20,000 on the skidder, but the skidder costs $30,000, so there's $10,000 left over, and so he's depreciating that other $10,000, so he gets to depreciate another $500 there. And then he takes the $60,000 tractor, 3-year property, goes to the appropriate maker's table, gets his percentage, and he works it out. And I've got these tables at the very end of the presentation. This is a little unique in here. You have to use the something like 29-year property, and he placed it in service in July, but they don't tell you what month. You have to go say which month was it placed in service, and it was the 7th month. That's where that figure comes through. And he actually can depreciate $235 that first year off the machine shed. But now that machine shed, he's going to be running a schedule here for about 30 years depreciating the machine shed. But anyway, Forrest Stump gets to write off, deduct, depreciate, whatever you want to say, $25,733 the first year, and that's a pretty good chunk of change there. Well, let's modify the example a little bit so that Forrest, what happened if Forrest placed the over-the-road tractor in service in September and the skidder in service in October? Well, this puts him in the different position of now he's going to have to use the mid-quarter convention because, well, he would have been able to calculate his depreciation deductions using the half-year convention instead of the mid-quarter convention. And this is going to result in an additional $16,500 more in depreciation deductions for the tax year. And this is, again, this is the same thing, $20,000 on the skidder, $10,000, but now this percentage jumps up because now we're in the mid-year convention rather than the mid-quarter, and he comes down here and now he's up another $16,000. So now he's able to deduct $42,233. But now, in 2004, he can write off everything under the Section 179, except for the machine shed. All right. Now, I don't know. I kind of offer this. Did anybody take any depreciation last year, 2004? Do you want to, I'll make this voluntary, do you want to go over the special depreciation allowance which expired December 31st? These were just some special allowances that were kicked in as a result of the events of 9/11. They gave us special accelerated depreciation, but it's no longer applicable. Anybody want to go over this? Any other questions on Section 179? I'm kind of cutting out those last 10 slides or so because, you know, it's about something that's not going to happen to you. And if you want to read about it, it's there if you have an academic interest in it. But basically what happened is If you acquired property after 9/11, they gave you a special accelerated amount that you could depreciate in addition to the Section 179 deduction, which would help you recover your costs even quicker, but it expired December 31st and is not carried forward. So what I've gone over with you now applies to 2005 and forward, except the 179 deduction rate is going to go up again.